begin by asking you, in your press conference, you did point out that FY25 is going to be a challenging year and FY25 growth is going to be similar to FY24. What makes you say that, and any green shoots that might support an argument for a bunched up recovery in second half?
I just want to make sure you understood my point. I said our assumptions for FY25 is the same as FY24 from a discretionary spend pattern. That's really what I mentioned. Of course, what will happen in reality is driven by a lot of external circumstances, which looks similar to what we saw in the last couple of quarters, but situation can change as well. So we are really not taking a view on what will really happen to the external environment. We've assumed a certain metrics, and we will see how that will pan out. Accordingly, we will come back to you. Overall, I think our deal momentum is good. We have a strong pipeline. We believe the first half of the year will be strong bookings, and that will drive good growth momentum in the subsequent quarters. And that's the optimism that is there with us to continue growing the business.
Right. Prateek, you quantified in the investor call as well the impact of the shift to offshore in Q1 and State Street in Q2. Could you detail that out for our viewers as well, and what kind of a dip should one brace ourselves for in the first quarter?
As you may have seen historically, the June quarter is the quarter where a large number of our contracts have that usual annual productivity passback for the customers. What that basically means is, let's say over a 5-year deal, there is a new level of pricing reset that happens on an annual basis. It so happens that a large number of contracts historically started around the March-April period, and that's the reason for that sort of seasonality. So this year it is kind of exacerbated a little bit more than usual because one very large contract really started off in March of 2023, and that has finished one full year, in fact 13 months, and now that contract is getting offshored, and there is the related consequent decline in revenues, but profitability remains constant, in fact becomes a little better once the offshoring is done. So that is the context, and given the historical accumulation of those contracts coming up for the productivity passback, that is the reason we called out, and the reason we sort of in advance told people is, one, so that everybody is prepared beforehand instead of getting a surprise later on in the next quarter. And second, also to explain the guidance that we have given 3 to 5% in constant currency, because simply, otherwise people were expecting a little more. I understand that was the expectation, and that's why we had to explain that and, sort of set the expectations for the next quarter as well.
Okay, so that explains the Q1 impact that we'll see. But what about Q2? The street impact will come there, and also if you can quantify the Q1 number.
That is a smaller impact. We had published that earlier as a 0.8% of our annual revenue. So you can sort of extrapolate that. That is not that big an impact as the first quarter, which is obviously much larger at -2%.
Right. And what's been the incremental trend that you've witnessed in the fourth quarter?
Continue to remain very confident about the medium and long-term prospects of the industry, and we delivered industry-leading growth in FY23. We followed it up with another industry-leading growth in FY24, and our outlook is still the best in the industry for FY25. So I think all of this should make you believe that we continue to remain confident.
Margins have been stuck in that 18 to 19 band for the last 3 years, and this at a time when your peers have managed to expand the margins, and the growth environment is the same for you as well as them, right? So they also don't have the growth lever, but they've managed to expand the margins and not really you. Could you help us understand what's going wrong and what are you doing to sweat the efficiencies from here on to improve the margins?
This 18 to 19% is again been very steady over the last 3 years, which is FY23, we had given the same guidance, 24 was the same guidance, and we delivered in the 18.2% for both those years as well. And we are just carrying that forward. The 19 to 20 aspirational band that we had talked about is certainly not in this environment that we've been going through in the last year and this year seems to be more of the same. So that has therefore taken a little bit of a backseat, medium term, as we say. So it's certainly something that we have in our sights, but that period will probably go a little outside or a little, more quarters away than what we thought earlier. The third point I wanted to make is there are other metrics of profitability that, from an investor point of view, may be even more important than just the EBIT. EBIT is important, no doubt, but there is...
Right. Mr. Vijay Kumar, what about the large deals though? Because apart from Verizon, large deals have been a miss. Is the pipeline seeing a heavier mix of small duration projects?
See, even in Q4, we did strong booking, $2.3 billion booking, which is a combination of large deals and small deals. And if you look at the pipeline, again, we have a strong pipeline, and it has got a good mix of large and small deals. And we expect to conclude some large deals in the coming weeks and quarters.
The deal TCV, deal wins dollar amount that we publish is really all of net new. There is not an iota of, renewal kind of element in that. We separate that out. And the second thing is the way we announce the deal TCV, it is what we call firm orders. It does not have any rate card kind of a thing with some assumed or projected volumes. These are actual commitments that the clients have made to us in a written SOW or MSA or purchase order, whatever the modality may be. I think that is important because otherwise every company is publishing in different ways and the number does become a little incomparable.
Sure, Prateek. Point taken. In fact, CVK Prateek, thanks so much for making time and speaking with us this morning. But time now to slip into a very short break. When we come back, we discuss the earnings of Mahindra Holidays with the management.